Trading using the 7% stock rule. Trading stocks can feel complicated, especially when markets move quickly and emotions begin influencing decisions. One simple approach traders can use to create more discipline is the 7% stock rule. This rule is often associated with the idea of taking action when a stock falls roughly 7% below an established purchase or breakout price. The purpose is not to predict every market move perfectly. Instead, it provides traders with a predetermined risk management point that can help prevent a manageable loss from turning into a much larger one. The 7% stock rule is a trading guideline that suggests selling a stock when its price declines approximately 7% from a predetermined entry price or purchase point. The idea is straightforward. Before entering a trade, a trader establishes how much downside is acceptable. If the stock moves against the position by about 7%, the trader exits rather than continuing to hope that the price will recover. The key principle is that the 7% figure is a risk management guideline, not a guarantee that a stock will recover or decline. Different stocks have different levels of volatility, so traders should consider the characteristics of the individual security rather than blindly applying 1% to every situation. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and use code BLOG to receive 20% off your next purchase. The biggest advantage of a predefined exit rule is that it removes some emotion from trading. Investors frequently make poor decisions when they become attached to a stock. A trader may purchase shares because the company looks promising and then refuse to sell when the trade moves lower because they believe the price will eventually rebound. A predetermined 7% loss limit creates a clear decision point. Instead of asking whether the stock might recover, the trader follows the risk management plan established before entering the position. This approach can also help protect trading capital. A series of small losses can be frustrating, but allowing one losing trade to become a 20%, 30%, or 50% decline can severely damage an account. Capital preservation gives traders the ability to continue participating in the market when better opportunities appear. 7% rule example. Consider a trader who buys 100 shares at $50, creating a $5,000 position. The trader uses the 7% rule as a maximum planned loss level, which places the approximate exit point at $46.50. Instead of falling, the stock climbs to $60. The trader decides to sell the position based on the broader trading strategy. The $10 increase per share produces a $1,000 gross profit before commissions, fees, taxes, and other applicable costs. The important lesson is not that the 7% rule predicted the $60 price. Rather, the rule helped establish a disciplined downside boundary while allowing the trader to participate in the upside if the trade worked. If the stock had fallen to approximately $46.50 instead, the planned loss would have been about $350 on 100 shares. This illustrates the basic risk-reward concept. Accept a controlled loss when the trade fails and allow successful trades room to generate larger gains when appropriate. The 7% rule becomes much more useful when combined with appropriate position sizing. A trader should not assume that risking 7% of the entire trading account on one position is necessarily appropriate. The 7% figure generally refers to the movement of the stock from an entry point, not automatically to the percentage of total account capital that should be placed at risk. For example, a trader with a $20,000 account who purchases $5,000 worth of stock would face a potential $350 loss if the position declined 7%, assuming the trader exited exactly at that level. That represents 1.75% of the total account. By contrast, investing the entire $20,000 account in one stock and allowing it to fall 7% would create a $1,400 loss. The same stock rule therefore produces dramatically different portfolio consequences depending on position size. This is why risk management and position sizing should work together. Some traders use stop-loss orders to automate their exit strategy. A stop order can potentially help prevent hesitation when a predetermined price is reached, although execution price is not guaranteed and can differ from the stop price, particularly during fast-moving markets or gaps. For a stock purchased at $100, a trader following a 7% guideline might consider a stop level around $93. However, the appropriate order type and placement depend on the trader's strategy, market conditions, liquidity, and risk tolerance. A stop loss is therefore a tool for implementing a trading plan, not a substitute for having one. Successful trading is rarely about finding one perfect stock. It is more often about executing a repeatable process over many trades. The 7% rule can become one component of that process. A trader might identify a potential entry, calculate the maximum acceptable decline, determine an appropriate position size, and establish conditions for taking profits. The trader then follows those rules instead of making a new emotional decision every time the stock moves. Over many trades, this type of discipline can be more valuable than attempting to predict every market movement. Conclusion: the 7% stock rule offers traders a simple framework for controlling downside and maintaining discipline. By establishing an approximate exit point before entering a trade, traders can reduce emotional decision-making and prevent individual losing positions from becoming unnecessarily large. The rule itself does not create profits. Instead, it provides a structured approach to risk management, capital preservation, and trading discipline. Used thoughtfully alongside position sizing, market analysis, and a clearly defined trading plan, the 7% guideline can become a useful tool for traders seeking a more consistent approach to managing stock positions. Thank you for watching.